I'm expecting a short-term bounce followed by a significant decline. Hello, this is Killer Whale. Today I took a video to share my latest perspective on Bitcoin's price action. So let's dive straight into the analysis. To give you my conclusion up front, I'm expecting a short-term bounce followed by a significant decline. That's why I bought Bitcoin when the price went down, and I'll be sharing my strategy in today's video. The reason I'm forecasting a major drop after the bounce is due to a critical clue I've identified in the price action, specifically in the wick of this candle. To fully understand this clue, it's important to go through all of my key points in order, so I recommend watching the entire video. Before I dive into the analysis, if you find value in my content, I'd really appreciate it if you could subscribe. You can always unsubscribe later when you are done watching but still found it unhelpful. The first reason is what's commonly known as the retail shakeout pattern. After a sharp drop to the $49K level, Bitcoin experienced a rapid rebound, followed by a prolonged period of sideways consolidation. At this point, many investors likely thought, the bottom is in. The trend has now shifted to bullish. This is the last chance to get in before the big move. As a result, many retail traders probably began buying in, expecting a strong rally. And for a brief moment, the price did rise, giving them hope, but it quickly dropped again. This left many traders stuck in their positions, unable to take profits or cut their losses. Most of these traders likely set their stop losses near the lowest point of this consolidation, hoping it would hold while they waited for the next move. However, the market broke below this level, triggering a wave of stop losses and forcing many traders to exit their positions. This is the basic principle behind the retail shakeout pattern, a common occurrence in the markets. Following this shakeout, we saw another sharp rebound. At this point, many traders once again likely thought, this time the real bottom is in. This is the last chance to buy before the real rally. They likely bought in again, and once more, they are probably stuck. And currently, the price has continued to decline, breaking through the previous low. In the process, the price also broke through the supply zone on the left, securing liquidity. Therefore, I believe the current zone is the most suitable area for a rebound. The second reason involves several technical patterns. First, let's look at the descending channel. This channel is defined by 3 key points, and it has shown reliable support and resistance at the midpoint, making it a highly credible channel. Therefore, it appears highly likely that the current zone will provide support and lead to an upward movement. Next, we can look at the Fibonacci retracement levels. The 0.786 retracement level, which is a key level in technical analysis, lines up with the first wave of the current move. Finally, there's an important low that was formed before the potential breakdown. This is a key support zone, and historically, levels like this tend to hold even if the market revisits them later. Now, let's combine all 3 of these patterns: channel support, Fibonacci retracement, and the previous low. When we mark the overlapping zones on the chart, we get a key support area between $53,300 and $52,400. Given how many technical factors align here, I believe this is a high probability area for a bounce. Let's move on to the next reason. The third reason focuses on wave analysis. This is a scenario I've been discussing for a while, but there has been a significant shift in the overall trend, which is why I'm sharing this update. Previously, I mentioned that we were in the midst of a complex correction, with one final upward wave still to come. The idea was that after the initial impulse wave up, we completed a corrective wave and another impulse wave would follow. I had shared that the first impulse was an extended 5-wave pattern, and I've now discovered a crucial clue. If the extended wave of the 5-wave pattern is fully retraced, it often indicates that we're at the end of a larger wave structure. During the drop to $48,500, we saw a complete retracement of this extended wave, which strongly suggests that this was the final wave of the previous upward movement. Currently, I believe we are in the retracement phase of the wave that started from the $15K low, with a larger correction still to come. However, the retracement period has been relatively short, so I expect this correction to extend further, potentially bringing more downward price action before any significant move upward. It's likely that we'll see a three-wave upward movement, with one final drop forming the last wave of this retracement, marking the end of this phase. That said, I don't expect the next upward wave to surpass the previous high significantly. At most, we might see a slight break above the previous high before the market resumes its larger downtrend. The key takeaway here is that whether we see a time-based or price-based correction, more correction is needed before the next major move. Now, let's summarize the key points of today's analysis. I'm expecting a short-term bounce followed by a significant decline. The current correction period has been relatively short, so I believe we'll see more upward movement before a larger decline unfolds. That concludes today's video. If you found the content helpful, please consider liking and subscribing. Thank you for watching.